Now, the point I was trying to make was that, and the left-hand slide should really be a nitrogen molecule, but it doesn't really make any difference, is that what we have is really a stable closed system. If nothing is injected, and we'll talk about later what that might be, we're going to have a really fundamental understanding of exactly where everything is located. These are just moving averages. Here's mean price. And these are just orbitals, S, P, and D. And the financial markets are exactly the same in terms of a closed system. You have a mean, which is this black moving average. It really doesn't matter what that number is. It's simply a mean. And then price will move off that mean, just like it does in any molecule, some distance away, described by the orbitals S, P, and D. And those are designated SPD in physics. And those can be additional moving averages. But if left to its own devices, price is going to want to stay close to the mean. And when it moves away from the mean, it's going to move out in predictable ways. It's going to move out along the S, P, and D orbital, or S and P and D moving average. So in both of these cases, we have stable closed systems. And the analogy is quite rigorous. Now, something can happen. Now, here's another closed system, because a closed system is operational on a microscopic level, and it's also operational on a macroscopic level. I mean, what keeps our solar system stable? And in this particular case that we know, it's gravitational forces and probably additional more trivial forces, but essentially that's what keeps these objects from flying off. And each of these orbitals is defined because we can define the trajectory and the magnitude of force that's applied to each of these objects based on our assessment of the gravitational forces. So we can know with great certainty where any of these are going to be at any given time. So this is a well-defined closed system. If left alone, will continue to be stable. Now, it doesn't necessarily have to be left alone, and that's what we're going to go into. Now, let's take the case of a supernova. I mean, this is on a microscopic level. What does it inject into that closed system? Well, it injects a tremendous amount of energy. And in physics, if you inject energy into a closed system, you're going to modify the closed system. So the amount and trajectory of the energy that's injected on a macroscopic level and a microscopic level are going to change that stable closed system into an unstable closed system. Now let's take a look at the financial markets. If left alone, they're going to move.
I think they will come Tuesday or Wednesday.
Hold on, I'm getting some background noise here. Okay, that's gone. They're going to move in a predictable way, and simple indicators are going to be able to predict price direction, and this is just simple stochastic. And here also is stochastic divergence, predicting a change in direction in price. Now, just hang on one second. Okay. Now, I don't want to jump around too much, but what I want to show you is this. I just want to jump a little bit to statistics for a second. And I'm trying to pull this together as best I can, and it'll all come together at the end, I promise you. Now, if you look at a divergent signal on 100 trades, if you take a divergent signal and you get 620 winners and 380 losers, and then you guess based on your intuition, and you get 580 winners and 420 losers, is the divergent signal effective? Are these additional winners statistically relevant, and does the divergent signal work? And I don't have the chat box open, and if you have any questions, I'll answer all the questions at the end. But the answer is this. What you have to do is you have to apply what's called chi-square analysis. And the answer is that the chi-square statistic is 3.33, the p-value is 0.0678, and the result is not significant. So in this particular case, the additional wins that you would get using a divergent signal is no better than guessing. And the fact that you do get more winners with divergence and fewer winners with guessing is simply because of it's just a chance random event. Now, the reason the p-value has to be less than 0.5 is this is probability. And the probability of what you get has to be less than 0.05 because that is less than 1 in 20. So there's only a 1 in 20 chance that this is going to be just happening by chance. This does not meet that level, and therefore there's no statistical significance here. Now, this is just 100 random trades. But I just want you to be aware and bring to your attention the fact that when we talk about one signal being better than the other, or one signal being inferior to the other, it has to be statistically relevant. And if we don't apply some kind of statistical analysis, which in this case is almost always chi-square, there's others like there's a Fisher exact test, and a Fisher exact test can have a one-tail or a two-tail. But these are all mostly discrete points, and therefore the chi-square works. But what I wanted you to see was, if you initially thought that the divergent signal was better than guessing, the answer is it's not. Now, let's just take a quick look at Fibonacci. Now, Fibonacci retracement is a popular tool that traders can use to identify support and resistance levels and place stop loss orders or target prices. Now, a Fibonacci retracement is created by taking two extreme points on a stock chart and dividing the vertical distance by the Fibonacci ratios. So you get 23.6, 38.2, 50%, 61.8, and 100%. Now, Fibonacci, I believe, was born in the year 1207. And Fibonacci has some relevance in nature, but it has absolutely no relevance in determining how any two particles interact in nature, and how somebody took Fibonacci and transferred it over to the market to predict how price was going to move out into the future is something that I've been unable to find. Although I've looked through Google, I found no seminal papers or any major scientific evidence to show that Fibonacci has any relevance. Yet, I think it's particularly sexy It's an easy way for software vendors to sell a package without knowing anything about it. But in my analysis, Fibonacci does not work. And we're going to talk a lot more about it. But here's Fibonacci, and you can always retrofit it. And this was just a curve I found, and you can see that between 0 and 100%, these levels appear to be relevant, areas of support and resistance. Now, the meaning of it is totally irrelevant. Now, the underlying principle of any Fibonacci tool is simply a numeric anomaly that is not grounded in any logical proof. The ratios, the integers, the sequences, and formulas derived from the Fibonacci transformations were only the product of a mathematical transformation. And while the transformation is not inherently wrong, it can be very uncomfortable if you want to understand the rationale behind its use as a trading strategy. Now, we're going to soon be moving miles away from this. I want you to know that. But I want to lay the foundation for certain things. Now, if you ask yourself, what is the rationale behind using Fibonacci to predict areas of support and resistance, you're not going to get an answer because there is none. Now, a Fibonacci retracement can only point to possible corrections, reversal, and counter trend bounces. And the system struggles to confirm any other indicators and doesn't provide easily identifiable areas that are strong or weak. So we don't know if one Fibonacci area is a weaker area, one Fibonacci area is a stronger area. In essence, Fibonacci as a standalone tool doesn't have any statistical relevance because there's no literature to support its gigantic teleological leap from simply a series of mathematical transformations that describe some symmetry in nature to how price moves in a closed system. Is Fibonacci used to describe how electrons move around the nucleus or how planets move around the sun or any celestial bodies? Therefore, if we look at as a Fibonacci tool, it's trying to describe the movement of any two bodies, whether it be of anything, whether it be price in a financial market, or, as I said, on a macroscopic level, planets are in our solar system. On a microscopic level, electrons around a nucleus. It fails on all those levels. So inherently, it has no mathematical validity. Now, I want to move to Elliott wave. And again, we're going to be making huge jumps from here. I just want to lay the foundation. Now, Elliott did work directly in the markets, and the foundation of Elliott wave and Gann theory, by the way, is based upon investors' predominant psychology. He found that swings in mass psychology always showed up in the same recurring fractal patterns or waves in the financial markets. So he based his 5-wave pattern on investors' predominant psychology. And Elliott theory somewhat resembles Dow theory, and that both recognize that stock prices move in waves. Now, Elliott recognized the fractal nature of the markets, and by fractal, he referred to movement on very, very small time frames. Fractal analysis I look at as multi-time frame analysis, whereas Elliott looked at it as the movement of price over very short periods of time. And he was able to break down and analyze them in really great detail. and fractals are mathematical structures which on an ever smaller scale infinitely repeat themselves. And he discovered that stock index price patterns were structured in the same way. So he looked at these repetitive patterns and believed that they were inherent in all financial markets as a closed system because of investor psychology. Now, at least, I put Elliott wave after Fibonacci, because Fibonacci, there is absolutely no foundation for its use in the financial markets, whereas at least Elliott wave has some reasonable basis in use. I mean, Elliott proposed it was based on investor psychology. So at least we know the underlying thesis for why it may predict how price moves. Now, here's how Elliott wave would look as a closed system. And all we've been doing is looking at closed systems that were simply allowed to move with their own intrinsic waveform or intrinsic pattern, or rotate on a macroscopic level without the interjection of any outside. On a macroscopic level, it would be energy. Now, on a microscopic level, or in the financial markets, it's going to be something else. Now, again, we know that if we interjected a massive amount of energy into our solar system, it might knock every planet off its axis and completely distort how everything moves. And if we were aware of the trajectory of the energy and the size of the energy, it might be possible for physicists to determine how everything would move after the energy struck. Right now, we're looking at the financial markets in the absence of any intervention by anything that might be considered analogous to a large interjection of energy. Now, what happens? Now, the analogy between energy on a microscopic level is the huge influx of institutional and bank money on a financial level. If you interject all of this money into these financial markets, they're not going to move the same way. You're going to distort this closed system. So what's going to happen is you're going to get price. Remember before, they moved in S, P, and D orbitals, or in the sense of the market, they moved in the SPD moving averages off mean. Now they're going to move to a orbital F, which is also present in physics. There's SPD, F, and G, and they're going to move far off the mean. And this closed system is going to be distorted. Now, our job is to determine the magnitude and direction of this force. And if we do, we can determine this new orbital F. And if we can, then we can use this interjection of money, which is nothing more than an interjection of energy in any closed system, and use it to help us make money. Now remember, when the system is stable, here, oops, let me go back. Price tends to hang right near mean. And what we really look for in the financial markets is that interjection of energy, because without it, it's really hard to trade when we're sitting in the SPDF moving averages. Obviously, in areas like in molecules, look, if we want to put together compounds using nitrogen, we have to distort it. We have to move energy into the system in order to create I don't know exactly what nitrogen might be using, but for carbon, complex carbon products. So it's really important that we are able to interject energy into these systems and money into these systems. Now, once we interject that money, we get this movement into the F orbital. And again, our goal is to define the magnitude and trajectory of that energy so we can track price and make money off this move. Now, if we're looking at Japanese candlestick patterns, now I want to say a couple of things about Japanese candlestick patterns, Elliott wave, Gann theory. They don't work anymore in today's market. And I know that they're so prevalently sold and proffered and taught that you really have to change your mindset. And this is one of the problems with technical analysis as a science. If I started trading in 1997, and when I did, the exact same set of indicators that were present in 1997 that led to 95% of day traders and swing traders losing all of their money are still present in today's market, proffered strongly and taught resolutely in a dogmatic way, and they still push 95% of day traders and swing traders into bankruptcy as far as their trading account is concerned. So as a science, this is a dead science. If you look at, say, medicine or architecture, look how far, now these are applied sciences. We're not talking about biology or physics or mathematics. We're talking about the application of these basic sciences. And technical analysis is an applied science. And if we look at this applied science, where has it gone in almost 45 years? It's gone nowhere. It's the same stuff. Now, back in 1996, there were no live webinars. Nothing was streaming. But I got a large number of financial newsletters. And back then, they were all right, because all they did was predict that everything was going to go up. And everything did go up until the year 2000 and until March of 2000, when everything went down. Then they were all right, because all they did was predict that everything would fall, and everything continued to fall. The bottom line, though, is that the science of day trading is almost non-existent. The whole point of a science is to test via rigorous mathematical analysis each indicator we look at its predictive value on a statistical basis. And if it doesn't work, reject it. And in its place, put something that works, to give us a better fundamental understanding of how price moves in a given market. And it doesn't matter what financial market we're looking at. It could be a stock, it could be a future, and it could be a Forex pair. It could be a bond, it could be a note, it could be volatility. These are all financial markets that have a price and that are defined by specific forces. And those forces are almost always institutional money, or the byproduct of institutional money. So if we stay down that 95% path, we are going to go bankrupt because that's really where we are right now. We're being taught the same stuff. Now, I love Japanese candlestick patterns, but all of the statistical analysis, I'm sorry, all of the technical analysis that we look at right now is based on one fundamental premise that George Lane used in 1957 when he created the stochastic. And that is that the power of each buyer is essentially equivalent to the power of each seller. Now, for many decades, that was the case. But in the last 20 years, that is so untrue because the financial markets are moved by big institutional money. They're moved by the banks stripping an algorithm and a computer going on and shooting price up, in a stock $4 or $5 or 5%, in a future 40, 50, 60 ticks, 25, 30, 40 pips. That is what moves the financial markets now. And it's actually the time to make money is not when the power of every buyer equals the power of every seller, which is what Japanese candlesticks and Elliott wave and Gann theory and almost every other indicator out there is predicated on. It's when there's this tremendous imbalance. I showed you what happens. It creates that F orbital, that trajectory of price off of mean. So in our particular case, we're looking for that supernova to go off in the markets. It renders all old style technical analysis useless. And we have to create a new style of technical analysis to accommodate a new age of price movement in today's financial markets. And if we don't, we are going to continue to lose money. In general, all traders are going to lose money 95%. 95% of traders are going to continue to go bankrupt. Now, if this was true in any other science, if this was true in medicine, most of us would be dead. And if I asked you to take a pill that for the last 40 years, if you had an illness and 95% of people died from that illness, and I asked you to take a pill and 95% of you are still going to die anyway, would you take that pill? Well, of course, the answer is no. Well, you're taking that same poison pill, and that poison pill is the standard technical analysis. It's never done anything for anyone in the past. What is the expectation that it's going to cure your ills going out into the future? And what I'm trying to do is show you, and not simply in an expository way, just say, okay, this doesn't work and this does work. Show you on a fundamental mathematical basis why what we do doesn't work, and why what I'm going to show you is trying to take into account what's operational in the markets today. And if we don't make an abrupt U-turn or left turn or right turn away from what we're being force-fed by 99% of the quote teachers out there, we are going to lose all our money. Now, I threw this example in because we know that if you look at the first example of stochastic, every time it was overbought, you sold, and every time it was oversold, you bought. But now we know that when big institutional money is operational, a stochastic can stay overbought for days, weeks, months, for years. and that you're going to get false signals that would have caused you early exits, or premature shorts, or allow you to get stopped out. That's just one quick example. Now, what happens to Elliott wave when we interject all that money? What happens to mass psychology? Remember, Elliott wave was predicated on the fact that given 1,000 traders, they would fundamentally have a psychology that would move the market in this way. But now it's not trading psychology moving the market. It's this interjection of huge energy, which in the case of the financial markets is huge money. This gets squashed and becomes totally irrelevant, as does Gann theory. I didn't put up a Gann theory slide, same thing. And what happens to Fibonacci? Even if it had any relevance, which it didn't before the markets changed, if we interject a huge amount of money or energy into the financial markets, this is just going to be rendered useless. And if you're looking for areas of support and resistance based on fib levels, they're just going to wipe you out. And I don't think anything has sucked more money out of traders' wallets than Fibonacci. I don't know why it has such mass appeal, but it's simply one of the biggest hoaxes I think ever perpetrated on traders. Again, not only does it have no fundamental use in the markets, not only has it never been proved to move it over into the markets, it's going to get squashed anyway by big money. When big money contorts how the closed system works and sends price off into that F orbital, this is going to become totally irrelevant. Again, totally useless. This is divergence. Now, divergence is a way of assessing a directional change in price. Now, I give a lecture on oscillators, and I believe that divergence was probably a very, very good assessment back in the 1950s and 1960s and maybe 1970s. But in today's market, when we interject this huge energy, this whole thing explodes. And if you try to call a divergent signal in the face of all of this energy being interjected into the markets in the form of big money via a bank triggering again a computer that's going to push price up forever until that computer shuts off, you're going to get beaten up. And this is what those 95% are trading and are taught to trade. Japanese candlestick patterns, man, there's so many companies out there that are based on them. That's all they do is teach Japanese candlestick patterns. And I like to look at them, and I believe they're interesting. But I would never trade them, at least not anymore. Now, here we have that stable system. No interjection of energy, no interjection of money. Price hovering right around mean. Any movement in this market, in this closed system, is going to work with oscillator divergence, Elliott wave, maybe with Fibonacci, although I doubt it, but it's irrelevant. It's an irrelevant argument at this point. Because again, here's what happens with the interjection of energy. I wanted to kind of reinforce that because it's so important. Now, if energy, direction, and magnitude creates sudden huge movement in closed systems in physics, big money creates sudden huge movements in the closed system of the financial markets. And we all know that to be true. It's institutional and bank money. It's computer-generated algorithmic trading, and it destroys market symmetry, rendering old age technical analysis useless. And we've got almost all traders using this old age technical analysis. Nobody's teaching anything different. The supposed guru mentors are still teaching it. And there's probably hundreds of new traders who enter the market every week. And what they face when they open up their computer is just this blast of powerful websites teaching the same thing. And it's just mass psychology. If they see it over and over again. Now the most important thing about what these traders teach is they teach it, but they don't trade it, and they don't trade it live, because if they did, it would expose the fact that it doesn't work. But they do teach it. So if we don't change the direction of how we trade, we are not going to become successful traders. Now, I don't want to say that I have the only right way to trade, because I'm sure that there are other ways of trading correctly. But I can tell you what doesn't work. And these are the things that just don't work. And I think I made a pretty good case for why they don't. Now, as I mentioned, all indicator analysis is predicated on one postulate. The power of the bulls approximately is equal to the power of each bear as the market changes direction. For every given incremental change in price, the power of each individual bull is equal to the power of each individual bear. That's what creates those wonderful Japanese candlestick patterns. Now, 400 years ago, when the Japanese rice traders created them, obviously that was true. 50 years ago, that was true. So when you got an engulfing candle, a dark cloud cover, a piercing candle, a shooting star, a doji, obviously those were important indicators of what the bulls and the bears were thinking, because those were the only traders who move price. It's not true anymore. And if we want to trade when the power of each bull is equal to the power of each bear, which we can, we're going to be trading when the market's like this, when there's no fundamental interjection of price. Now, this is not necessarily chop. It's simply price that just hugs the mean, which is the way this closed system wants to move. If left to its own devices and left alone, just like that nitrogen molecule and the way those electrons orbit, it's going to move this way. That's just the inherent nature of this closed system. So in physics, energy distorts a closed system. And in trading, big money distorts a closed system. Again, we have to know the magnitude and direction. Then we can predict directional movement and resultant effect. If we can do that, we can make money. So let's take the first thing that big money does. Now, this is the same blue line on 3 different charts. And I purposely did not put in a time frame, and I purposely did not put in a financial market, because the time frame and the financial market are irrelevant. The only thing that's important to know is whatever this time frame is, this is 3 orders of magnitude longer, and this is again 3 orders of magnitude longer. So if this is X, this is 3X, and if this is 3X, This is 9x. So one thing we do know is that the injection of a large amount of institutional money and price rocketing straight up into that F orbital is right here. And what it does is it creates a multi-time frame alignment in trend. And it doesn't matter what this time frame is. If this is, again, 3 orders of magnitude and 3 orders of magnitude greater, this is when you're going to trade. Now, it's hard to watch and look for this kind of alignment. And if you look up here, you can see that there's no interjection of money. I don't have any other indicators up there. I don't have mean price, but this is just price doing what it normally wants to do. Stay tight to mean price. Then all of a sudden, bam, institutional money comes in and rockets price down. So in order for us to trade, what we did is we created this background bias. And what this background bias does, and this is the exact same move I just showed you, is it looks at 3 time frames. And when you get that multi-time frame alignment and trend, you know it's time to trade short. We have harnessed the ability to determine the magnitude, which is never, we're never quite certain, because the magnitude is going to be how far price falls. But we know the trajectory, and we know that the power of this force is great enough to create a multi-time frame direction and trend without having to look at 3 time frames. Now, this is the most powerful indicator we use, and it's an indicator that it doesn't care about stochastic or fibs or oscillators or any of the stuff that traders look at. It simply looks at when there's an interjection of big money, and big money creates so much power that it pushes price down on 3 different time frames, creating this. The dark pink is the strongest, the light pink is weaker, but it's still a downward movement in price all the way through. This is very, very helpful when we're trading. When there's no alignment, multi-time frame alignment in price, we're back to this market. And where there's no interjection of big money, i.e. energy, and we can't trade it. And if we trade without a multi-time frame alignment, we're trading without the interjection of big money, and price is just going to hover in those SPD orbitals tight to the center or mean price, and it's nearly impossible to get a winning trade. I don't care what the oscillator says. I don't care what MACD says. I don't care what Fibonacci says. All I care about is that multi-time frame alignment in price. That is my cue that this, and this is unlikely to occur unless there's that interjection of big money. Now, when you get that interjection of big money, and I just didn't have the time to create the 3 slides, we do use an oscillator, but we use an oscillator it's called the Linear Oscillator. We modified it, and what we do is we don't look to fade it, we look to trade in the direction of it. But one of the fundamental premises that we trade with is that no single time frame analysis is powerful enough to give us any information. If the analysis comes off the trading chart, it's useless. If it comes off the higher time frames, it's going to tell us where price on our trading chart is going to go. And this is the multi-time frame alignment of the Linear Oscillator. So what happens is that when you get the interjection of big money, it also plasters the Linear into the oversold direction and holds it there. And it does it on a multi-time frame basis. Now, there's nothing that could keep this oscillator plastered into the oversold region for an extended period of time, except this huge imbalance where there's tremendous selling pressure. So we're looking at the exact opposite of the way the markets used to move. Again, they used to move in a way in which the power of each bear equaled the power of each bull. Now it moves when there's incredible buying pressure, or in this case, incredible selling pressure. And that's what we want to track. And that's the direction that we want to trade. Now, does Japanese candlestick patterns have any relevance here? No. I mean, if they try to call a bottom, are they going to work? No. If we look to fade an oscillator, is it going to work? No. If we look to try to fade MACD diversion, is it going to work? No. Because we're trading against energy interjected into this closed system that is creating, in this particular case, such significant selling pressure that you see these up candles in here. I mean, buyers are trying to turn the market all the way down. There's 3 green candles, there's an up candle. I mean, what are they doing? And why are they doing it? Well, they're trading what 95% of traders do. They're calling a bottom. They're trading oscillator divergence, MACD divergence, Japanese candlestick patterns, Elliott wave, Gann theory, all the things that we know are distorted beyond recognition with the interjection of big money and the distortion of this closed system. All of those signals now become non-operational. And if we try to trade them, see, we got like 5 green candles in a row. But what are they going to do? They're all going to get stopped out. We have to trade in the direction of the multi-time frame Linear. Now, here's the NASDAQ. And the reason I put this instrument up, and we were looking at the NASDAQ all along, is because what we're trying to do is the interjection into this closed system that moves it is big money. Now, in this particular case, we know that it's going to create a multi-time frame alignment and trend. And we also know that it's going to create tremendous selling pressure, enough to create a multi-time frame alignment of our Linear oscillator plastered into the oversold region. Now, if I looked at this and this was heading down, not quite so steeply, and then on my 3-time multiple, I got some moves to the upside. And then on my longer term time frame, it really wasn't moving to the downside. I mean, these are more gentler decreases in price. We know not to trade. We know that big money is not involved. This is the only time we want to trade. And what we also remember, our goal in the markets is to trade with specificity, not sensitivity. Our goal is to avoid losers, not get winners. If we try to avoid every potential loser, we will make an enormous amount of money if we can do that successfully. That's trading with specificity. If we try to get every winner, we will suck in tons of losers, and we will wind up with a trading account of 0. Most day traders and swing traders try to grab every winner. It's one of the cardinal sins of trading. You have to stand aside until you get a perfect setup. Now, what is better? What is another proxy of this tremendous distortion in market symmetry as a closed system? Well, it's the distortion of multiple closed systems that correlate. So in other words, if there was a huge amount of energy interjected into the solar system, it would knock out every planet, all 9 planets, if you count Pluto, where I read some people say it is a planet and some people say it's not. And it doesn't matter to me ultimately, but if it's going to knock them all out. So if we look at the direction of the NASDAQ and big money is driving it down, shouldn't it also drive down the Dow, the E-mini, and the Russell? If it does, we know that there's big money is not only distorting one market, it's distorting 3 others that have a lot of overlap. I mean, in the NASDAQ, there's a lot of stocks that are also in the E-mini. And in the NASDAQ, there are a lot of stocks that are also in the Russell mid-cap. Now, the Dow's a little bit of an outlier, and I'm not going to go into how we correct for that. But what we look for is a multi-time frame direction of correlative markets. We don't want just the NASDAQ on a multi-time frame basis to be falling. We want the Dow, the E-mini, and the Russell on a multi-time frame basis to be falling. And that's what these 2 lines represent. A decrease in price on a multi-time frame basis of these 3 correlative markets. Every financial market that's out there has correlative markets. It's just a matter of finding what they are. Because remember that the big institutions, all they do all day is rotate their money from asset class to asset class. When risk is on, they pile into stocks and they distort all 4 of the asset classes to the upside. When risk is off, they're selling and they're distorting these closed systems to the downside. And we want these all to be in sync. And it will be unusual, although sometimes it does, where the Russell will be going up or sideways, where the E-mini and the Dow are going down. We may miss that move, but we don't care. We only are looking for the lowest risk trades that are out there. And again, how does this in any way correlate to Japanese candlestick patterns or to Elliott wave or to stochastic divergence or MACD divergence or anything else that we look at? It has 0 correlation. Now, the other is that there are defined areas of support and resistance. And those are defined in real-time terms by, again, big institutional forces. Now, if we look at a change in direction on one time frame, which is a pivot, it does have value. But what we do is we do a multi-time frame analysis of buy, sell imbalances. And we call these zones. And in this zone is where there's a significant overabundance of sellers. And in this zone, there's a significant overabundance of buyers. And this is done on a multi-time frame basis. So I think you're getting the idea. And the idea is that when the market's distorted by big money, the only thing that matters and the only thing that's going to pick it up is this multi-time frame analysis and alignment of multiple markets and multiple time frames. So this gives us tremendously powerful areas of support and resistance. You would never trade into this support or up into this resistance. If you did, you would run into huge problems. Now, we also look at the multi-time frame assessment of order flow. And I'm not going to go into the nuts and bolts of how we calculate it. It's a market delta moving averages on a multi-time frame basis. But in that case, we look at the candle halo as the assessment. And again, the multi-time frame assessment of order flow has no relevance to any classical indicator analysis. And it doesn't care if there's a doji. It doesn't care if this is the fourth wave of an Elliott wave pattern. It doesn't care about any of that. And you can see when order flow is aligned to the upside, you in general have tremendous buying pressure. When the candle's haloed in black, there is no alignment. And again, when it's haloed in blue, you move to the upside. Now, the importance of all these analyses is that price rising does not create the blue halo. The blue halo means that off the right edge, price is going to rise, because this is a multi-time frame assessment. If this was just being done off your chart, the right edge would be right edge movement would be totally unknown. But because this is a multi-time frame assessment, on that blue candle, the next candle is likely to be up and up and up and up and up and up and up. Then when you see the candle haloed in magenta, order flow has changed direction. Then off the right edge, you're going to presume that price is going to fall. Now, in this particular case, price just went sideways. But ultimately, I didn't pull it out that far. I wouldn't be surprised if price fell. It fell here. Here was just a little bit. But here was the big move. So we're trying to harness everything we can to look. And again, what is order flow but a different way of assessing tremendous buying pressure and tremendous selling pressure? Order flow looks at a market delta. A market delta looks at a volume ladder. A volume ladder looks at whether there's a preponderance of sellers or buyers on the dome. It's a more sophisticated analysis of telling us who's present in the market, more buyers or more sellers. And when analyzed the right way, it does have significant predictive power. So based on our assessment of how a closed system in the financial markets operate, we know that big money distorts these closed systems. The distortion sends price far off the mean, which in our case is good. In physics, this distortion can also be good if it's controlled. If it's uncontrolled, it can be a disaster. The distortion creates a multi-time frame alignment of multiple independent variables. And you'll notice that order flow is totally independent of the multi-time frame direction of trend in terms of its assessment. One assessment is not dependent on the other assessment. And the Linear, the multi-time frame assessment of the Linear is totally independent of the multi-time frame assessment in trend. These are all independent predictors of the directional movement of price. One does not depend in any way on the other. And the distortion renders one-dimensional and waveform assessments useless. So all those waveform assessments forget, and any indicator that only creates its predictive power off of one time frame or one dimension is never going to work when we want it to. In fact, it's more likely to mislead you into a loser than it is to get you into a winner. And that's why traders not only go broke, they go broke fast. I mean, when you lose your account, you lose it in a week or 10 days. And I don't care how big it is or how small it is. You go right off the cliff. And I can go into those J patterns. Now, I didn't want to pull this out and go into rising triangles and falling triangles and bull flags and bear flags. But again, that analysis has been around for 50 years, and it's never made any of us a dime. So why should we use it? When big money comes into the market, do you think it cares whether price is in a falling triangle or a rising triangle. It couldn't care less. You think it cares whether it's in a bull flag or a bear flag pattern? It couldn't care less. Now, all of these things have meaning, but they have one-dimensional meaning. And when big money comes in, they're all going to get distorted and they're all going to become useless. Now, this is the full system. And if I have time, I'll bring it over. Now, we like to use Unorenco. These are modified Unorenco bars, but it doesn't make any difference what type of candle you use. Time, tick, range, Renko, Unorenco, it's irrelevant, because all you're doing is looking at a visual way of displaying price. All we want to do with our analysis is harness that big money distortion and use it to our advantage to create buying and selling opportunities. This first line are those correlative markets I talked about. That second line is the multi-time frame direction of the Linear. This green is the multi-time frame direction and trend. That halo is that multi-time frame assessment of order flow. And you can see how when background is green, price and order flow is there. Now there's more on here because there's more nuance to the system. But the bottom line is the fundamental nuts and bolts I completely described to you. Like I described for you the hot dog, and this is like the mustard and the mustard and the relish. These are the additional things we add on to give the system additional specificity. But the core system and the theology we use to create it totally ignores all of the other ways that 99% of traders trade, and the way that 95 to 99% of mentors teach you how to trade. It's simply not going to get you anywhere. And unless you use this analysis, in my humble opinion, believe me, you're not going to be profitable. Now, remember what I've said. I don't believe in any way, I would never be so arrogant as to say, I have the only right way to trade. I'm sure there are other valid systems and other ways of making money, but I can tell you that this is definitely one of them. So that's as far as I'll go in terms of telling you the power of the system. And I can definitely tell you that if you use the stuff that's out there now, you are never going to make money with it. It's all unidimensional. It's all twisted into a pretzel by big money. It never fires off an appropriate signal. And you should take your fibs and your Elliott wave and your Gann theory and your MACD divergence, and in fact, anything that's looking at price on your trading chart only, and get rid of it, because a multi-time frame analysis is mandatory. I don't want to go back to the slides before, but if we go briefly and we look here, what we learn from looking at one orbital at the S, we have to look at the P, the D, and the F. We have to do a multi-dimensional analysis. This moves the same as a nitrogen molecule. If we don't look at all the different orbitals and waveforms, we know nothing about the movement of electrons around this nucleus. So if we look at one indicator or any indicators that only look at price on our trading chart, and we look at a unidirectional assessment of price, we learn nothing. And like I said, it's more likely to blow us up than to give us a really nice assessment. Now, I'll show you really quickly a full chart, and then I'll show you our offer. And hang on one second. Let me just, here. I mean, here's gold. And this is a live chart. And you can see when we trade. We trade when we have that multi-time frame alignment to the downside. And price almost always falls. Now I'm off the edge. I don't have too many days in here. Right here is the multi-time frame alignment to the upside. Now, if I put in a few more days, we can look at a little bit more price movement. I only have 4 days. Why don't we put in 10? It's going to take a minute to calculate because remember, it's doing a multi-time frame assessment and it's doing a multi-market assessment. That was pretty quick. Let's move over. And I mean, this is a terrific move up right here. And look at that move down. Now, when the area is clear and there's no multi-time frame alignment and trend, we're not going to trade. We need to have everything red below, along with this dark pink background. That tells us what's going on with big forces. And there's our short. And let me tell you, none of this has anything to do with oscillator, MACD, Fibonacci, Elliott wave. None of it is of any relevance. Now, here's a big move we can't trade. Like I said, we're not going to get every winner, but we're going to avoid almost every loser. And here's another terrific short. So that's gold. And I did want to show you a live chart because I can cherry pick and look at this move up. Now, cyan is a multi-time frame alignment to the upside, and up you go. You're almost never going to be caught in the wrong direction. You're almost always going to be caught in the right direction. Now, the only other question you have to ask yourself is who's trading these candles? Why are they going short? We've got the correlative markets long. We've got the multi-time frame Linear plastered, so we know that there's powerful buying pressure here. Our chart Linear is plastered to the overbought area. We have a multi-time frame alignment to the upside on gold. So we know that the distortion in this closed system by big money is long. Why would anyone sell? And these are the traders that are trading the old style method. They're also creating these wicks. These are all bear failures. They're trying to pull the market back and they're creating these wicks. And this is a bear failure, bear failure, bear failure. Every time the bears create that down wick, they're run right over by the bulls. Now, eventually you're going to top out, but you get not after a huge move. And I could, I could show you multiple markets, but they all move the same. And I'm telling you, this is the only thing that's going to provide you with an advantage over all the other small commercial traders. Remember, our fight is not with the big institutions. The distortion that they create, we cannot beat. Our fight is with the other small traders. And if there's no reason why, given the way they trade, we can't go home with their money. Why should they go home with our money at the end of every day? When we're harnessing this distortion in a closed system appropriately, and they're looking at it from a way where it was looked at 40 years ago. They're actually creating, I don't want to go into it, but every down candle that they create gives us an additional buying opportunity. Because when you catch traders in the wrong direction, it's going to push this move up because they're going to get stopped out. So we need these small retail traders. And us as small retail traders, if we can't beat these other small retail traders, well, shame on us. Because we should have more knowledge in these financial markets than these small guys. We should be the small guys that win. They should be the small guys that lose. You know, it's a dog-eat-dog world. And if you're in my trading room, I want you going home with money. I don't want them going home with your money. So let me show you the offer. It's a really great Cyber Monday offer. And I'm telling you, I really mean this. I know there's a lot of marketers, blah, blah, blah. But I've never sold all of this for this low. Now that full software package is normally $3,000. And what I'm also putting in there is a technical analysis masterclass. I think it's 12 to 14 hours. It's digital. And it goes into such detailed analysis about every single indicator that I went into. And not just the major ones, but also not only the hot dog, but it also goes into the relish and the mustard. It tells you what every dot means. And one thing about our charts is we never leave anything on our chart unless it increases the predictive value of getting a winner. If it doesn't, we blow it away. And let me tell you, we've blown away tons of stuff that I thought was going to work but didn't. And we do a statistical analysis, and if it doesn't work, we kick it out. And you're going to get a month with me in the live trading room, so your learning curve is going to be extraordinarily high. And the price is only $999. And that's for a lifetime license. So you own it forever. You're never going to pay us another dime for the software. And it's free upgrade. So if we make it better, you get that improvement. And I'll tell you something. This software is so different than the software that I first came out with in 2012 when I started this company. And I have traders who started in 2012, and they must have been upgraded, I would say probably 100 times, because we're constantly improving, because this is an optimization process in which you strive for perfection. You want to create a software workspace that will give you 100% winners and avoid 100% of the losers. That's our goal. Is it achievable? No, it's mathematically unachievable, but it's still our goal. And our goal is to make things better. Almost everybody else has a static workspace. Being around since 1996, I've seen 100 workspaces, and they're essentially the same, or they dump everything when they run out of buyers and create a new one, but they don't evolve. And that's what our workspace does. If we see something better, or I think of something better, we add it, and you're going to always get those upgrades. So you're going to evolve with us. So it's just good for Cyber Monday, tonight and tomorrow. And honestly, this is the cheapest price we've ever sold it at, ever. With these inclusions, I mean, that's the lowest price ever. So let me see if there are any questions. I'll be happy to answer them. And there are. Let me get them back here. I just didn't want to throw the workspace at you without giving you some scientific background and put this whole thing in context. I mean, if you get a lecture, and I don't want to go too late. Get a lecture on Japanese candlestick patterns. They don't go into the scientific understanding of why they should work. You have to accept a priori that they are great, and all you have to do is learn them. So if you learn what an engulfing candle is, wonderful. If you learn what a what a doji is, wonderful. But what is the scientific rationale that Japanese candlestick patterns should work at all? I've never heard anybody go into that in any lecture on Japanese candlestick patterns. And all I hear about is people selling everyone's selling secrets now. If you want to buy secrets, you can buy them anywhere on the internet. So let me see. Hey guys, hey everyone. I think you got my sound now. Hopefully you got my sound. Hold on. Okay, great. Got sound. Okay, good. It's a little worried there. Listen, Ron, I'm not going to read that out loud, but listen, if that person wants to use Fibonacci, let her do it. Like I said, I mean, there are all kinds of opinions. I'm willing to bet dollars to donuts they don't work, but what can I say? Hey Ford. Hey C. Based on your presentation, you would never want to trade unless volume suggested there was institutional players. How much is volume? CVIC is enormous. I did not go into volume, but if you look here, and I'll bring a chart over, you see this number right here in the lower right-hand corner? That's minute volume. And that tells us how many contracts are crossing per unit minute of time. Here's total volume. So that's that's a great point and a really good question. And that is volume. And you can see right now there's almost no volume turning. Now we do have an additional indicator, which you do get. I don't use it because I just use the lower right-hand corner, and it's called our volume hammer, and I'll show it to you. Now the volume hammer is a visual representation of this number. And what it does is it traces out a line every minute. Now volume really doesn't have any leading properties to it. Volume is what it is. But if you want to look back and see how volume was based on every minute, you can. And this is going to stay minutes until you change it to 2 minutes, 3 minutes, 5 minutes, 15, an hour, 2 hours, irrespective of your trading chart speed. So you can actually get a visual representation going into the past of how much volume crossed per incremental unit of time. But that's the number I look at to tell me if I do, in fact, I'm walking into an institutional wave, because that number just skyrockets. And if you have a visual representation here, you're going to see a big spike, like right here. Now this is after hours, but if we go to a market that's open, you're going to see these big spikes in volume right here, right here, right here. Now the problem is that this gets a little distorted because these big spikes, this is almost 2,000 contracts a minute, pushes this down, and you really need to crosshair it. Because even when you're all the way down here, you're still crossing almost 500 contracts a minute, which isn't huge, but it's not bad. But we do use volume really strongly. See. Hey, Paul, how does the futures market correlate to the futures market? If the NASDAQ stock market moves 20 points, will the NQ? No, listen, we've tried to do that, Paul. We've tried to make a correlation between the NASDAQ cash and the NASDAQ futures. We spent months on that indicator. And what you needed was a kinetic data feed. You needed up volume, down volume, stocks up ticking versus stocks down ticking. It was very complicated, and the correlation is just not tight enough. There is a loose correlation, Paul, but there's not a strong one. That's a great point, though, because we thought about it, and I'm like, well, you know, if the NQ stocks are going up, what's happening to the NASDAQ futures market? Well, it's going to rise, but it's not going to rise tight enough in correlation with the cash markets in order to leverage it as a metric to help us with our trading. And boy, did we work hard on that indicator. I mean, we literally, I swear, we spent months on it, and it got us nowhere. All right, Gary. Hey, Heinz. Sure. Let me just do this quickly because I don't want to go too far over time, but I will. I'll give you the NQ. It's got to load. Now this is a little bit of a fast NQ. Remember, we use a little bit of a slower, but this gives you a general idea of how it moves. I'm start, you know, resetting, but here's your NQ on a faster speed. And again, it obeys our laws, as every financial instrument will. It really, in all cases, there's your up. And in here, we're not going to trade. And I mean, look at this. I mean, this is a huge move down right here. So the NASDAQ is no different than any other market. Now I don't have any of these lower line set for this speed. I just want you to know that, Heinz, but I just wanted to show you the NQ. Alan. Oh, did I say November? I'm sorry. Well, I mean December. Oh, where did I put it? Yeah, it's December. I'm sorry. Just don't worry about it. It's December 2nd, Alan. Thank you. Hey, Scott. I know it's December. It's a typo. Are the templates with settings? Yeah, we have all the templates with settings, Gary. Everything. All the settings and templates are set. Hey, Mitz. Any market you want. Mitz, you can trade any stock, any future, any forex market. It doesn't make any difference. Remember, they all obey these rules. You know, if you want to trade a 1 minute or a 3 minute or a 5 minute, I mean, it's easy for us to give you templates, but it does not make any difference what financial instrument you trade or what time frame you use. We have traders on 4-hour bars, daily bars, 15-minute bars. You need NT7, NT8, Stuart. It's very easy if you have Thinkorswim, because Thinkorswim data feed will power NT7 and NT8. So you don't have to pay for NT7 or NT8, and you can stay on Thinkorswim. The cost of market data, Mitz, well, listen, if you have a broker that supports 7 and 8, you're not going to pay for the data feed. If you don't, and also if you have Thinkorswim, you're not going to pay for the data feed. If you want to run this independently of any broker at all, then you're going to have to pay for the data feed. And the data feed and how much you pay is going to depend upon what markets you want to look at. It could be anywhere from $40 a month to $100 a month, depending upon how much, you know, whether you want to look at gold, crude, the Forex. But almost everybody, if they trade, has an account with a broker, even if they trade SIM, and the broker provides the data feed and then you don't have to pay for it. Hey, Alan. It'll be recorded, Alan. Hey, Philippe. There is scanning capacity, Philippe. You're going to have to call us because I just don't have the time to show it to you. But we have a really, really unique scanner. And with it, you could watch an unlimited number of futures, forex, and stock markets. And what the scanner does is it looks at all the independent variables that are present on a chart. It looks at the quant, the Laguerre, the background, and tells you, it'll give you a buy signal when you've got all that alignment. I mean, you're going to have to call us and I'll talk to you about it, but we do have a scanner. I just didn't include it in that package. Hey, Joe. If you know what? I think for most of the slides, I looked at crude oil. Some of them I looked at the NASDAQ, Joe, but it really does not matter. The reason I removed the instruments is because it's really irrelevant. They all move exactly the same. And that's why I took them off the slide, because I don't want you to get hung up on what instrument you're looking at or what time frame you're looking at, because it doesn't make any difference whatsoever. Hey, Russ, very interesting presentation. What each of the lines on your chart represents. Here's the thing, I can't do that, Russ, because if I did, the lecture would be over at 11 o'clock tonight. It's just, I mean, what Russ wants me to do is explain every line and everything, and I just don't, I could do it, but I can't, it's past the scope of this, Russ. Really what I wanted to do was give you one full chart and give you the philosophy behind how we trade our indicators. If I did a full class on every indicator, it would take me 3 to 4 hours. That's what the master class does. It goes over every indicator. It takes 12 hours to really do it in depth and put it all together. In the trading room, it's really quick. But in this webinar, I wish I could, but it's too much, Russ. And I'm already at 90 minutes. So just respectfully, I'm going to have to defer on this. Hey, Mohammed, it's from Canada. It's too expensive from. No, Mohammed, we've got a great broker for you in Canada. If you call us up, Rory will give it to you. We found a terrific broker and you do not have to use Ninja. They support, you don't have to use the Ninja Trader guys. They support it and they're cheap. And they're really, really great. They're really pretty much for Canadians. I just don't know their name, but if you call us, we'll give it to you, but you can just come into the room. But the room, whoops. It was an advertisement for Ninja, but the room's $199. And if you can come up with a little bit more, you're going to get the room anyway and everything else. So if you call us, we'll give you the broker, and when you speak to them, they're going to love you if you're from Canada. Trust me on that. Hey, Dan. No, it's 7 or 8, either one. But it is unfortunately exclusive to Ninja. But you can use a lot of other software to power it. Hey, C, I've been to Light Trading Room where there's no volume. Is that room markets make no sense to me using your analysis? Well, we make money, Vic. I'll tell you that. We made $3,500. Look, our goal is to make $1,000 a week in the room, and we made about $3,500 to $3,600 last month. We just missed our goal of $1,000 a week, and we only trade a very tiny number of contracts to get to to get to that goal. So, you know, we're profitable, I'd say 8 out of every 10 trading sessions. And that's just factual. And I have a ton of people in this lecture, in this webinar who are in the room, and they know it. I couldn't just make that statement. Mohammed, I don't really know. You know, that's really Rory's area. If you can call us on Skype at Rightline. Our Skype is rightlinetrading.com. I'm sorry, it's Rightline Trading. Because if you're located outside the United States, or if you're located in Canada, or if you're in Canada, you can just call us. It's toll free. No, they only work on Ninja. But you can get a great Ninja broker in Canada. Hey, Dan. Absolutely work on any stock, Dan. Any stock. Stocks move no different than futures. And you can trade it with Tesla, Netflix. That's how I do all my options trades. And I use the software. And you can pick your own time frame. Per day, we looked for 300 to 500 per day, Rob. $1,000 a week, consistently. For, you know, this is after commissions, for a total of $4,000 a month. And we're only trading 2 contracts or 3 contracts. I mean, here's the thing. If you can reliably, dependably make $1,000 a week on 2 or 3, then essentially the amount of money you make is absolutely, the sky is the limit, because you can just double the number of contracts or triple the number of contracts. So if we can make $4,000 a month or $1,000 a week trading 2 on crude and oil, crude and gold, 3 on the NQ, then it doesn't make any difference. I mean, if you want to make 8, 10, 12, honestly, as long as we trade with enough precision to create a really beautiful positive equity curve every month. You know, I don't trade a huge number of contracts because most traders in the room have small accounts, and I want them to be able to keep up with me. But as long as I create a nice, solid, positive equity curve, everybody makes money. And a lot of people in the room make a lot more than I do. And I want them to. Hey, Richard. In the room, I trade crude, gold, and the NQ. And let me tell you, in the holidays, last week, we killed it on crude. The NASDAQ, because at the end of the trading session, I bring over my performance from my NinjaTrader back end. We go over all the trades, and we go over it by market. We see how much money we made on gold, how much we made on crude, how much we made on the NQ. And gold and crude were our cash cows. And the NASDAQ was really tough. Index equities going into the holidays lose volume. They get choppy. We don't get that big distortion in those closed systems. But gold and crude, man, holy God, we got big winners on those. So that's what we normally trade. And we only take 2 contracts on them. Just a small number. Mitz, I don't know how much the data costs because I don't know what you want to trade. In other words, if you want to buy it from Kinetic, it all depends on what your markets are. Now, I buy the Kinetic just in case as a backup data feed because I'm in the room and I've got 175 traders. And if something goes wrong with my normal CQG feed, I have a backup. And I trade crude, I trade gold, and I trade the index equities. And it's relatively inexpensive for me. But if you want to trade, if you want to add stocks, if you want to add Forex, it would cost you more. But it's not that expensive, I can tell you. No, I understand. I totally understand. Hey, Russ. No, my pleasure, Russ. Hey, Mohammed. Yeah, just give us a call, Mohammed. Oh, the night room. Well, listen, I know that David's a good trader, see. I really don't monitor it, to be perfectly honest with you. I got you. Yeah, I totally get you. I do. Hey, Rob. No, Rob, you can trade as many contracts as you want. I mean, we'll configure the platform for you. We do everything. Sergio, who's full-time here, has a master's degree in computer science. And he'll do he will configure your automatic trade management strategies. He'll set it to as many contracts as you want, and he'll teach you how you can vary the number. I mean, we have traders in the room trading 20 contracts. So there is no problem trading more contracts, more shares of stock. You can do, that's totally up to you. No, not at all, Rob. The number of contracts you trade, remember, we're trading those distortions. Those are high volume moves. So those high volume moves, where that energy is supplied by big money, are also big liquidity moves. So you're going to have no problem with trading bigger contracts, a bigger number. Hey, Philippe. Traditional technical analysis have been overpowered by big institutional money in recent years. I've been using the Linear RSI for over a year now. Nice, Philippe. That's a great tool. It'll be better for you though if you use a multi-time frame analysis of it, Philippe. But the Linear is the best because it was not made to look for divergence. It was created to stay with that overbought, oversold analysis, and you're going in the right direction. Hey, Richard, the trading room is I get in there like 1 minute before 9:30, and I trade usually till we hit our profit target. I mean, a couple of days last week we hit it in 15 or 20 minutes. And one of the things about being a good trader is you decide how much money you want to make, and once you hit it, you stop. So we looked to 300 to 500. We hit it quick a couple of days, and we were done in less than 45 minutes. But what I do in the room is I usually don't close it for another hour because I do a lot of teaching. We go over every entry. Remember, you can make money on a bad entry. I want to make sure every entry I took was a good entry. And I just get a lot of questions from everybody in the room. So it's a very nice community of traders. And we talk for like an hour after each trading session. Yes, I do, Mitz. The problem is I don't have the info. It's Rory who does. And I'm at home tonight. I mean, our office is closed. If you send us an email, I'll get Rory to check this, and I'll make sure you get all the information. We have a great, I'm serious. We have a great UK broker for you. We really do. They cater to Canadians, and they strongly support NinjaTrader. You'll get really good commissions, and they want Canadians. So don't worry about that. No, it's my pleasure. So listen, everyone, have a really, really great evening. If at the very least, I tried to make this educational and give you a better understanding of the way the markets move. And I hope whether you come aboard or you don't, you at least have a better understanding of what to look for and what to avoid. Because I want you guys as small traders like myself to make money in these kind of markets. And hey, listen, it's my pleasure. I mean, look, we're in it to take money from the other small guys. Let's do it. And there's no reason why we can't. And if this information helped you in any way, it's my pleasure to provide it. Have a great evening, everyone. We finished with the turkey weekend. Now it's back to the grindstone. So have a really, really great evening. And hopefully I'll see some of you in the trading room this week. Take care, everyone, and have a great night. Bye-bye.